welcome to the session, and thank you for taking out time to join the session. We look forward to a great knowledge sharing session on the topic, the evolution of ERM for risk informed decision making. Uh, I've got our panel members. The way we have structured is we will have a panel discussion. I'll probably take few minutes to set the context of why the topic and what was the thought behind the topic, and then you know reach out to my esteemed panel members to get their views on different facets of the topic of how they are seeing the journey of ERM evolving in their organization and around them. Uh, in parallel, during the sessions, feel free to use the Q&A window to add in your questions. We towards the end of the sessions, we will try to answer as many questions as possible. In case we miss out on sharing some insights, please do reach out to us separately. Happy to share insights, views separately out of this webinar also. So without wasting too much of time, I will take this opportunity to welcome our panel members. So thank you all for taking time. Uh, I'll start with Surat Mukherjee. Surat brings over 33 years of experience in the space of risk management. He's currently the head of internal audit at Bennett Coleman, the Times Group, and has previously held executive positions at prominent Indian conglomerates like Dalmia Bharat and Sony. He successfully established a strong risk management program across the organization that supported the company's ambitious growth. His leadership has played a key role in enabling the business to navigate complex challenges with a focus on sustainable results. So thank you, Surat, and welcome to the panel. Uh, then we have Mr. Chetan Mathur. Chetan is a seasoned finance executive with over 30 years of experience in the consumer goods industry. Chetan serves as an independent director, angel investor, and board members across various companies like Pratap Snack, Inflection Point, and Traction Solutions. Prior to his advisory role, he was the finance leader for PepsiCo India and led various finance transformation projects across Asia. Thanks, Chetan. Welcome to the panel. Uh, we have Mr. Harish Sharma. Harish brings 24 plus years of diverse experience across M&A, governance, and digital transformation. He is the group head of management audit and assurance services at Adani Group and previously worked back at Torrent Power. He focuses on ensuring that all key risks across the multiple businesses that their group has are continuously monitored and mitigated. He specifically focuses on alignment with risk management program to ensure that the company's objectives are delivered and there is maximum value to the stakeholders. We also are waiting for Mr. Setu to join in. He's just going to be joining in any moment. Uh, Setu, I'll take the opportunity to introduce him till the time he's here. Setu brings in 24 plus years of experience, including 9 years of service in Indian Army. He's currently the global head of enterprise risk management at HCL, where he focuses on enterprise risk, strategic risk, and AI risk management. He was previously associated with Emphasis as a senior vice president and chief risk officer. With his extensive background in IT and finance risk, he is a key figure in disaster recovery, strategic planning, and information security. Uh, so that's the esteemed panel that we have today. So thank you all for taking out time for the session. Before I reach out to you, just for the benefit of all the people who have joined in, I'll just take a few minutes to set the context of why this topic and what can the group expect from this session. I'll just put up a few slides for everyone to go through. Just give me a second. So while the topic is quite obvious, but just for the interest of the group, what is risk enterprise risk management? As per the definition, enterprise risk management is defined as a culture, capability, and practices integrated with strategy setting and execution that organizations rely on to manage risk in creating, preserving, and realizing value. The key change in the 2017 definition of POSO has been integrated with strategy setting, and that's where the paradigm shift in the ERM, the way it is being looked today, is really coming along, where it is moving away from a assurance program and being integrated with strategy setting to deliver value to the CXOs, to the business leaders. SEBI LODR, there have been multiple compliances requirements that have been called out. So as per the SEBI LODR, in 2021, there were the limit of top 1,000 companies, listed companies has been included, which needs to ensure that they implement ERM and the different requirements called out as part of SEBI LODR. So if you look at it, there's a key focus on applicability of RMC, what will constitute in it, what kind of members, the number of meetings and quorum that needs to be delivered, what are the clear roles and responsibility of RMC members, the powers given to the RMC member to seek information, to ask the difficult questions around the compliance, the level of controls, the maturity of the organization to handle risk, and disclosures, clear disclosures in the annual report about RMC. Now, coming back to why this topic, this is a typical ERM journey that any organization will go through. If you look at it, it's bucketed into three buckets. ERM infrastructure, which is more around the policies, the frameworks, the risk identification and mitigation, which is more around identifying what are the risks the organization is exposed to, what are the measures that team has, and what are the timelines they have defined to really manage and mitigate those risks. But when it comes to the last bucket, which is the risk monitoring and reporting, that's where when we connected back, when we work back with a lot of risk leaders, CROs, IA heads, compliance heads, governance leadership, board members, the common concern is ERM really delivering me that value? Is it really focused? Yes, I have designed, I have implemented ERM, but is it really delivering the value? Am I really leveraging my ERM to make risk intelligent decisions, or am I just meeting it as a compliance requirement? When we consolidated this view across different industry leaders across India, we thought this is the topic where we should get a panel members who have been in this journey, who are actually moving ahead in this journey, and probably have also matured their ERM framework to deliver the real value. So what is the paradigm change that we are talking about? Traditionally, ERM has been looked at a tool to mitigate risk. But if you really think about it, the second side of the coin is where the new age ERM function need to look at. It needs to enable risk taking. It needs to provide the right information, be a lot more proactive, analyze that information, look at what are the different risks, whether it's a geopolitical risk, whether what the competition is actually doing, what are the technology risks that the business is exposed to, what are the cyber risks that the business may forecast or foresee going forward. How do you really analyze that information, get the right information, and generate that insight, which you are able to provide to your CXOs, your business leaders, to actually change a strategy if required, and make sure that the strategy is now aligned to the changing risk landscape that one has. That's the key change in the ERM function as we see today. So with this new age ERM, if you look at it, the focus is to really manage risk, but also write the risk, convert a risk into an opportunity, and align my strategy well before time to make sure that I'm ready to convert a risk into an opportunity. And let's take an example. Let's see how this has really happened. If you look at the camera industry that a lot of us have been familiar with, a journey for a company from a leadership position to a bankruptcy, and we're talking about Kodak here. Back in the 1970s, Kodak, when analog when analog cameras were the invention was in fashion. Kodak was a market leader at that time. During that time, in 1975, Kodak actually invented the digital camera, but they never took it seriously and never brought it as a product that they want to pursue and build a portfolio around. What if you look at that era, you're talking about almost a 50 to 60 years of market share where they have been the top leader in the analog camera space. When they identified or invented the digital camera, what could have been the risk mitigation plans? Probably the risk mitigation approach was to ensure that they do not cannibalize their existing product line, ensure that they continue to grow the business, and probably avoid the risk of losing out on the investments done to make sure that they're within the risk appetite that has been defined. If you change the lens and look at it from a risk taking ability, if that decisions or that information was available, if the ERM function at that stage was evolved to say, what is going to be the future technology trends? What are the competition really investing and bringing new R&D spends to evolve new technology in the camera space? The decision may have been different. They might have actually pursued on the lines of building a digital camera product line. As they did not do, new players like Sony, Canon, Nikon came in the 90s and took over the whole digital market space, the digital camera market space, and could have ended up filing for bankruptcy. And it doesn't stop here. As you move forward, come 2010, 2023 now, rather the 2020s, the evolution of digital camera within the phone space again changed the landscape of the risk for those companies. And now the new age companies, the technology companies which are bringing in phones with higher resolution cameras have changed again. So the risk landscape has again changed. What we notice is a risk which was relevant for 50, 60 years, as now the risk life cycle is reduced to 10 years to probably now where you get a new product, you are actually in a space where the risk might change within few months. So the risk is changing at a rapid pace, and so does a plan. Our ERM framework needs to change to make sure that we are looking at the risk a lot more proactively to generate that value. So quickly summarizing what we learned and why we did this, the risk exposure is changing at an evolved rapid pace. The risk is not only internal, but there are multiple external factors like globalization, like geopolitical, information sharing, the whole cybersecurity, which can impact the existence of business. So one needs to have a broader horizon. And thus, a traditional ERM may not be able to serve the purpose to deliver value. It's done occasionally. There is a periodicity on which you do a risk assessment and you report it back to your leadership. It's a lot more assurance focused. It's a lot more at a process level rather than at an overall enterprise level, and a lot more qualitative. And thus, the stakeholders are probably not getting the right value. Coming to the topic, this is the reason why we kept it as an evolution of ERM, where it now will focus a lot more on risk-informed decision making, ERM being the enabler for it. As an ERM program, how do we provide management and board with relevant risk and opportunity information that can support decision making during strategy and objective setting and performance management? So movement from a compliance to strategic mindset and risk listing to a risk informed decision making. With that as a context set, I will probably shuttle back and shift my focus, request our panelist members to really share their views on this topic, which we thought will be a great knowledge sharing session for different people who have joined us from different companies and different parts of India. So I'll stop share this. Back to our panel members. So I'll probably go first to Suraj, you and Harish. Given your vast, extensive experience, how do you see the focus of ERM changing in your organization, and where do you think you are in the journey of ERM? Is it more focused on compliance, or are you gradually moving towards a lot more value delivered through ERM program? Surat, you may want to start, and Harish, please join in post that.
Sure. Yeah. Good evening, everyone. Thank you, Nitin, for this wonderful introduction to this very exciting topic. And we all can't overemphasize the need of a subject which we all in this panel have seen evolving in front of us. Like this is a subject which we, maybe 10, 15 years back were reading more in theory and kind of an aspirational topic to something which we are now living because as you rightly mentioned, the risk cycle of anything and everything around us has shortened to such an alarming proportion that it really at times I ask myself that is it good enough to write it down and challenge it and mitigate it by the time it may be gone. It's like riding the supersonic jet kind of a thing. Having said that, the fact is that enterprise risk management always entails those risks which are up there, something which we as a business, the promoter group or the key management personnel, they eat for breakfast, lunch and dinner. So that's all the time they're talking about it. That is something which can either keep them on trajectory or just throw them out of trajectories, right? So we are talking about not the bread and butter stuff, but things which can actually impact the long term uh, profitability or long-term guidance which has been given to people around us. So it's extremely critical that when we jot them down and when we note them down, it is a very, very interactive document which needs to be referred, not as an annual exercise where we do it and then we file it away, but something which we regularly refocus on the moment a milestone is passed or a milestone is missed, that how do we predict it to happen, how it was supposed to plan out and how it did plan out, because there could be a government regulation which can change, which can suddenly change your playing landscape. There could be a compliance. Just maybe a month or two back there was this government guidelines on authentication of advertisements which you publish, which came up and which really made publishing any advertisement very tricky, because you have to get this assurance as a content creator and as a publisher that it is true and fair and it is giving the right message to the people. Whatever is written on the advertisement is correct. This came up because there was one Ayurvedic brand, I'm not naming it, which did some misinformed ads for a long period of time, and then there were these legal tussles and all, and as usual, a lot of knee-jerk reactions will come up and without really looking into how the other stakeholders will manage. But then again, sanity has been restored and the government has decided to give it to an empowered committee to look into the real operating side of it also. So it is extremely important in today's world that we look at all these parameters and play the game along with all the stakeholders. So government is the biggest stakeholders among all of us, the regulators, the competitors. So you need to collaborate closely with competitors. So today gone are those days when you shy away from competition. Industries need to collaborate together, to grow together, to complement each other's product, each other's strategies. That's extremely important. That ESG frame of mind, that collaborative frame of mind is important. We are not going to kill each other, but if you collaborate well, you can actually grow together and solve problems, because business is nothing but solving problems. If you don't solve somebody's problem, you are not going to be in business tomorrow, because if that either the problem doesn't exist because of an intervention or the problem has been solved more easier by somebody else. So we have to, in today's world, be absolutely, as you rightly mentioned, Nitin, that we have to ride that risk. We cannot be chasing it, we cannot be before it, or we cannot be by bystander. We have to ride it, we'll have to accept it, and we have to accept the norm that these risks will be there and they will be ever changing. Their teeth and nails will change, evolve, they'll scratch you, they'll push you, they'll pull you, but eventually all or any organization which can manage and which can profit out of these opportunities will be smiling at the end of the day, or a week or a month or a year, whatever you say. So it is extremely important that we take it extremely seriously. It's not a tick in the box or a governance job alone anymore, but organizations which lasts for long would have done something good around it. Like we as an organization, we are 186-year-old organization. So any organization which lasts this much has to navigate through multiple things. They may not have had this as a structured measure at one point of time, but I'm sure people manning the organization would have handled it in one way or the other. But today, the need for a structure is more important, because that is where you can establish to your governance board, to your shareholder, to your stakeholders, that you have been present here and not oblivious about something which has been there. But even after that, disruptions may happen, but you are on a better side of the story at the end of the day if you are monitoring it.
Thanks, Surit. So I think definitely the frequency at which you talked about to look at the risk and not really wait for an event to happen, collaborate at an industry level, and the structure for driving this ERM, I think are great pointers of how you are driving it. So thank you, Surit, for your views. Uh, Harish, you also deal with a very dynamic risk portfolio given the number of different businesses that your organization operate in. How do you ensure that the risk objectives are actually met? And as you look at ensuring that the compliances are there, the value is delivered, how do you bring all of that together in your planning to ensure that the risk management is effectively delivering to the expectation of management?
Sure. So, thanks, Nitin. So, at Adani Group, basically, ERM is strategically positioned to do both. It ensures compliance while empowering business leader to make a well-informed and risk-aware decision. So, we have a very robust ERM mechanism in our group. So, all the listed companies, there are very niche companies. So, this risk management framework is tailored to each business unique characteristics. So, our overall risk management framework is designed to proactively respond to the external challenges. So, ensuring that despite our large scale operation, the overall risk profile remains balanced. So, basically, in our risk management, apart from as Suraj told about, because the promoter run, there are certain critical risks which are to be run for the business being at the top of the promoter. Apart from that, there are certain governance emphasis which include like sustainable procurement or IT part. So basically include the cyber part of it, resilience against the market and the regulatory shift. So these are the certain key aspects which we continuously focus on that. So each business focus on the respective aspect, which for example like port, they are focusing on more on the industry's risk. So any slowdown in the economic activity, how to manage that growth perspective, or timely completion of the projects. A lot of projects are going on. So how to complete that project on time? Otherwise, that could have an impact on both regulatory aspect as well as on the profitability. Similarly, in a cement, they are maintaining like a market position in a dynamic industries environment. How to maintain that? What are the impact if it is being changed, and what are the mitigations for that? And in addition to that, there would be a fuel and the raw material security challenge. So that are certain key drivers which have been focused and managed at a business level, so at a risk management level. Apart from that, there was for example, in Adani Power also, there would be a certain focuses would be on like a regulatory, because it's a more of a regulated business, or regulatory risk are there. Commodity coal price fluctuation in terms of both commodity and the foreign risk is the key focus. A lot of merger acquisition is happening, so that is also one of the focus. So these are the business specific risk focuses are being kept. So at a group, the whole ERM is structured that's an independent committee, subcommittee has been formed, which have a various agenda. If you include like merger and acquisition committee, which is being headed by the independent director. So they are focusing on the risk aspect of the various merger and acquisition, suppose in thermal. So what are the is that the target company is covering all the aspect? Is that any challenges are being managed? What is the objective? So all these aspects are being validated, discussed, deliberated in that particular committee. Similarly, we have a legal and regulatory tax committee. Reputation risk is also been covered. Commodity and currency risk, as I told. So there are a multiple committee, independent committee on a quarterly basis, evaluating various aspect of the risk which can impact on the objectivity of that particular business. So either it would be a port or power or binding. So that is a different independent committees have been focused on that, and they this multi-layered oversight ensure that our risk management practices are both rigorous and adaptive to the changing environment.
So thanks, Arishan. And I think the key highlight that I see is given the dynamic nature of or the multiple kind of businesses you deal in, there are going to be very, very unique different sets of emerging risks that one needs to keep on identifying. Like Surya talked about the frequency at which you need to keep on identifying and managing the risk. While I'll take that as a cue for the rest of the group to share more emerging risks. But before that, Chetan, if I request you to share a very different perspective of how you as an independent director, board member, look at ERM. What is your expectation from ERM? And if you have to call out those top 3, 4 things that you look at from a board perspective, that as a service provider, as a team of risk management, what is it that you would like to see?
Right. Thank you, Nitin. Thank you firstly for inviting me and allowing me to share my thoughts. Again, I think both Surat and Harish, right, have shared broad perspectives which are so pertinent and so relevant to our discussion over here. Uh, Having been on both sides of the table, which means not very long ago, I was an employee, and this was part of, let's say, my remit. There are a couple of things that let's say, I worry about as I sit on board, right? The first piece is that how embedded is this process, right? The challenge that I see, and again, I know I can't speak generally about everybody, but I'm talking about the organization that I worked with, is that while there is a lot of information and there's a lot of, let's say, knowledge that's available, okay, and possibly practices that are available at senior level, the challenge is that every operating manager should should uh, should be actually working with a risk lens, right? Because there are operating, not routine operating, but even non-routine operating decisions that are being taken across the board. Now, whether that's and I'll go back to a factory, and you say a factory manager, he takes a lot of not business as usual decisions. And the question is, are we applying risk lens at that point of time? I think that's the worry number one that I have. Uh, I know it's a journey. And the other piece is that the velocity, I think Surat kind of referred to. Our challenge is that a lot of our actions that earlier would take a few, I mean, sometimes years, or let's go back to your Kodak example. You're looking at 60, 70 years, and then 10 years, and now 6 months. To some extent, to me, that's the velocity of a lot of risks that we have started, we've started experiencing. In the FMCG space, 6 months ago, we were at a stage where there was no demand, the consumers were not buying. Then suddenly they started buying, but when they're buying, yeah, the quality of buying is going is different. The category of consumer who's buying is different, and you are at crossroads. So if I were Bajaj Auto, should I concentrate on my EV, or should I continue to work on ICE? I think there are enough examples out there, and again, in the FMCG, I can quote many. So that, to me, are some of my let's say, some of the things that, like I said, they kind of keep me awake, right? I hope that helps.
Yeah, thanks, Chetan. Relevant when we prepare for board, what are the things that one should look at? Uh, Setu, I request your views also because you have a fairly active risk committee board. how do you ensure that you are taking the right information which is relevant for them on a periodic basis? Over to you, Sid.
Nitin, am I audible?
Yes, you are.
Thank you. Thank you, Satish, Harish, and Chetan. Yeah, um, I have two strands of thoughts. One is just to chime with what other panelists stated. We are in an era more philosophical one, the first one, and the second, of course, definitely, specifics that you asked me, Nitin. The first is that we are in an era where we are talking of double exponential change. If somebody has read the book, The Singularity is Coming and Singularity is Around the Corner, right? You will know that, just now, I think Chetan alluded to that, right? The speed of change today that we are talking is phenomenal. By the time you understand things, by the time you make sense of it, I think the water has already flowed. So given this speed of change, especially in the tech sector that I'm operating, right, it becomes very, very important how we can also, organize our risk management function to take care of the changed situations that we encounter, and also provide the right assurance both to the management as well as to the stakeholders. The second is the VUCA world of business. I think we should all keep in mind that this VUCA world of business, again, it is linked to what I just said, the speed of the volatility, the uncertainty, the complexity, and the ambiguity that we're talking continues to evolve, and rather it only increases in manifold proportions. Then, the third important aspect that I want to emphasize is that as a ERM function, while every risk within our or that is faced by the organization is within the remit of the function, what is more important from a board perspective is identify the black swans and manage the gray rhinos. When I say gray rhinos, the reason why I'm telling is 95% of the time, or even 98% of the time, the larger risks are well seen, it can be seen, it is there in front of us. Many a times we choose rather to ignore it, and then, or we close the eyes, and that is the denial, that is the result of the denial syndrome that generally the top management goes through because of business pressures and other things. So given these, philosophical foundation that guides me and probably my function, the way in which we see things is one, risk intelligence. The board is very keen to understand what are the macro developments, what are the strategic developments that have happened, that have changed within the internal environment that can impact the achievement of objectives. Definitely, at least on a quarterly basis, they are keen to understand how things have changed from the assumption that we made when we took strategic decisions, and how it is going to impact our strategic objectives or achievement of business goals, etc. is a key thing that they look forward in any of the briefing. Then the second one, definitely, that I take to the board is, the status of the top risks that are faced with the company. While we do that exercise to see through and identify what is more concerning, what board wants to know in the start of the year, what are the top 10 or 15 risks that they want to know, whether it is good, bad, ugly shape, what they want to know. So they want to understand where are. So some of it are related to strategy, some of it is related to, say, cyber, some of it may be related to governance. Not to downplay that, because the board has got definitely several mandates, and one of that is the corporate governance. So they are keen to understand how the overall culture and the corporate governance area is what is the status of. Of course, definitely the last 2-3 things are in terms of performance of overall internal controls, and then the incidents and crisis events, because that is the proof of pudding of how the risk management is working within the company in terms of how many incidents happen and how did we manage it. See, today nobody can say, especially in the cyber world, that nobody can say, no, I was not attacked at all. So that's a falsehood, right? So definitely, how many incidents happened, how did we manage it, what is the minimum loss that we incurred is what they are keen to understand. The last one that I want to highlight, among all these, whatever I just highlighted, gets reported with the risk appetite lens that they have, the board has set. That is the most important thing, because the risk appetite becomes the yardstick to measure how much risk a function is taking and how much risk we can afford to take. So that becomes a very important aspect when we present the dashboard or the report or anything, to show that whether, see, it is not only to say that whether we have we have crossed the risk appetite limit, but especially in the strategic space, I have seen this helps to show whether we are taking adequate risk, right? It is like, I gave you 100 crore, the safest bet is to go and invest in FD and, say that, yes, I made some, 8% profit. Is that what you can do? Or can you do more? Can you take more risk and, bring more profits to the company? So that risk appetite lens becomes a very important thing for providing all these inputs. Over to you back.
Thanks a lot, Setu. I think covered the journey of how a robust evolved function will look like, including with a very important message that how again enabling that ability to take a informed risk decision to say that I want to maximize my profit, my growth, my presence in the market with a risk appetite lens, and ensuring that you have the right information. So, and you again, Chetan, you talked about it, the pace at which the risk is changing. Harish did share about, what are the different risks that their organization is managing across different kind of industries that they operate in. Surat, I'll come back to you on this one. What do you, with the quick changing risk landscape that we spoke about, what will be that top 3 emerging risks from your organization point of view that you want to focus on, or you are proactively trying to manage, which you foresee to hit you in the next 6 months, 1 year, and you're preparing for that? Just top 3 according to you.
Yeah, Nitin, so I think the risks which we need to address, one is definitely the digitization of content, that continues. So it's not maybe something which just goes away from our plate. It just gets bigger and bigger because of more and more players, more and more type of content getting created, and user is obviously swaying in between. So that's one big one. Second is generative AI, and that's one big issue which we are trying to get hold of, because while that is one of the biggest enablers in our business line, that also poses significant threats with respect to authenticity of content, plagiarism, and the source of that particular content. So that we are trying to tame that animal to make best use of the same. At the same time, how do we make sure that we are in the pole position with respect to how we reshape that technological intervention into our business lines. The third is, how do we remodel our advertising package, our advertising revenue, to make it more interactive and more customer friendly. It's like the customer wants to have more with less. They want to have a more interactive experience. They want to have a value addition from what they see or what they hear. So how do you engage with the customer? Through QR codes, through interactive uh, you know uh, interactive video platforms. You have freebies, touch and feel, smell, uh, and different kind of interactive campaigns in which you engage with the customers to make sure that they read through your advertisement, understand what your advertisement talks about and how they can get value out of it. Something which the advertisement gives you uh, uh, an access to, which otherwise you will not have access to. A new product, a special discount, a special peep-in to a particular launch or a sale. What is it that you can bring to your end consumer which can be of more value to them as compared to what they are getting online? So these are the aspects which we have to keep on battling, keep on fighting on a daily basis to create value for the consumers and the customers.
Thanks, Surat. Chetan, any views from your side in terms of, you do work back with a lot of FMCG companies. From an FMCG company point of view, what are the top three emerging risks that you see which is changing now for the next 6 months, 12 months?
Right. No, so Nitin, let me just pick up from where Surat kind of left, right? So he talked about consumer, right? And I think that remains a common source of conversation or common issue across industries, whether it is media that he is represents or FMCG where I kind of work, right? So the question over here is that uh, the fast changing taste of consumers now, whether it's health and wellness and or perceived health and wellness, or it is also the go-to market. Till yesterday I was quite happy dealing with wholesalers, and today I find if I'm not in the e-commerce space, I'm irrelevant. And you know what, e-commerce is looking at, I just don't want to distribute, but I want to become profitable. And therefore that comes a whole whole play around pricing and quantity and all of that stuff, right? The second piece is technology, and technology for me or for our industry would be, how do I use machine learning, and how do I use smart analytics, and how do I use tools like this to identify in let's say in if I can't say advanced, but early enough trends in my data, which is huge, which is and honestly speaking, not enough is done to look at trends or to find out what's coming our way. uh, Again, your classic Kodak moment, right? I mean, can I identify whether this new technology is really going to stick, or is it another passing fad, right? Right. That's, I think those are one areas that I would kind of identify, call out. I would also call out effectiveness of this whole process, right? Somewhere along the way, unless this is really integrated and converged, right, between process controls, between enterprise level risks, between compliance level risks, and there is a robust let's say mechanism, okay, of, and again it's a bit of a utopian idea, but the fact is that convergence to me is kind of critical, and it's something that we should should be investing in if we have not. Hope that is.
Oh, thanks. Thanks, Chetan. And something that we do here, when we work back with FMCG clients, so the top concern that he called out. Uh, Setu, I'll take the discussion in a different direction. We heard Harish called out multiple different emerging risks. Chetan called out, different risk again when we look at from an FMCG perspective, and Surat again called out multiple emerging risk in his industry. Similarly, you have a lot of different emerging risks. To keep pace at and to be able to really identify these risks more scientifically rather than reactively, which has been the historical way of managing it probably. How do you think technology can play a role in managing all of this, helping you to enable you to identify emerging risk more proactively? And to what you said, getting that right set of information to your leaders to say that this is the insight that you need to factor in to take your next strategic decision. Uh, your views.
Thank you, Nitin. Um, it is an aspiration that I'm pursuing as a CRO. Earlier I did, and as a head of risk now. But I do struggle with this. But what is promising is the advent of AI and related technologies. Definitely, it is giving hope that we are we are in the threshold of having change. Whether it is our directors, whether it is top management, whether it is others. A dashboard or something which is real time, that gives them the right information that they can take the decisions, even strategic decisions, uh, which are well informed, right? So the adoption of technology at various levels, digitization of our entire workflow, integration of our internal environment, because many a times big firms, big companies, enterprises, you see they are having this disparate technologies, and they don't talk to each other, and many a times there are monarchs within the enterprises who hoard information, who don't share them. That is another big this thing when it comes to use of technology to leverage. So, like what Chetan said, how do we make best use of machine language today? How do we ensure that we have our own LLM and then put all the information, corporate information, because today it has got the capability to provide predictions that can help us take decisions faster and fastest. I will just at the cost of 1 minute, I will give you one example, quick example from my previous this thing, as to how technology uh, helped, or technology based uh, uh, inputs helped the company to do what they did. We were trying to acquire a company in SFO, that is a cyber security company. And since I was in my earlier role, I was also heading the business, cybersecurity business. So this came to us, and the tag was that we should go back to the investment banker within 15 days. So I was very keen. I did everything to crunch the time, and by 10th or 11th day, we set up the review meeting whether to go no go decision was to be taken. CEO, all the stakeholders, guys who were involved were called. Exactly 1 hour before, the investment banker sent the mail. The candidate is no more available. It is closed. And the interesting part is just the previous day, the acquirer, they went with the team. They went just only to start the discussion. They continued the discussion through the afternoon. They spoke to their backing team with the data that they gathered. They did the analysis, and in the evening they opened the champagne bottle, closed the signed the non-binding agreement, and left. It is a $275 million deal. It is there in the public domain today also. Why I'm telling is this is the speed of decision that we should be able to help the business to take. And do we have that level of information available, whether it is in the form of risk information or lack of information contributing to inability to take risk? See, the two aspects. One, the risk related information, and second, the inability of the right information with the stakeholders who are taking decision to take the strategic decision. So there is no second thought today that adoption of technology is is the in thing. There is no second thought about it, and we need to quickly adapt this. The faster we adapt, probably we can contribute both to the risk management as well as to the organization in a big way in terms of managing the risk better and effectively. That much I can tell you now. But this is a pet topic. We have invested heavily on this, whether it is in terms of horizon risk sensing or whether in terms of setting up the risk intelligence. In fact, Nitin's company, Protiviti itself, is supporting us in one of the important initiatives within the risk intelligence space. So we are heavily invested because we feel, and I strongly feel, that risk intelligence is the most important thing that the management needs today to get that clarity, to get that clarity of another 10 meters while traveling in a hazy and foggy road. All others are seeing 10 meters. If we want our people to see 20 meters, then this is the this is the panacea that is available to the management. So with that, I will give it back to Nitin or to you.
No, thanks, Sidhu, and I can relate it to a lot more, given that I've been part of that journey along with you. And I think you also touched upon it. Chetan also touched upon it. I think it's not about availability of information, which is a challenge today. One part of the digitization is that the information is freely available. It's how one really analyzes that information and generate that business insight and share it with the relevant stakeholders across the value chain in the organization and enable them to take that right decision. I think that's where, as we work back on some of these risk sensing tools, leverage these risk sensing solutions, one is able to bring that insight. And in the journey that we are doing with you, Setu, we clearly see and hopefully, deliver that value to enable that change. And that's broadly the paradigm change that we are seeing, where leaders like you and others on the call have actually started saying that I want to challenge the existing ERM framework because my risk is changing very frequently. Enable me with the right insight for me to go back and take that informed decisions. So I think that's the key essence we wanted to capture today. It's a topic which we can debate and discuss for a lot longer. But in the interest of time, I'll probably take a pause here. We started by talking about how organizations have started the journey where Surat and Harish talked about the different risk lens that they apply and the frequency at which they are looking at the risk. Chetan, you shared the board perspective of what are the key things. How does people on the ground apply that risk lens to enable that change management to ensure that value is getting delivered across the organization. Setu talked about how the end-to-end program of bringing all of this together and generating that insight to the board, to the risk committee, to the different members to enable them to take that risk intelligent decision is extremely important. That's the paradigm shift. We hope that all the audience who has joined us did have great takeaways, a lot to ponder of how we go back and deliver that extra value to our stakeholders in the organizations. There are a few questions which I have got. I'll just one of the things something that we also hear. ERM is something more experience based, or are there specific skilling that people should really go through to apply that risk lens? Harish, your view of how you see people building that knowledge for EMR or the lens of looking at risk from a different angle.
So, Nitin, what we have done here is that because it's a very specific competency is required. It is not a very generalistic, so specific competency is required. What we have done is that we have identified behavioral and functional competency. So we have defined that, like in a behavioral, like strategic orientations, so that how he is can able to join the dots. Then project management capability. So we have identified certain key behavioral as well as the technical competency, and based on that we assessed the team. So it is not that anyone can do a ERM, so it's a very specific knowledge we require. So what kind of how they are connecting with the stakeholder, so there is a whole set of competency been defined at the different level, either at a manager level or at a senior leadership level. So what could be that competency, and there is a third party who assessed on that competency. So this is something which we on a regular basis, on a yearly basis, we upgrade on the first. We assess on that, we identified is there areas of development, and then the individual development plan been prepared. Either it would be a kind of a specific training or kind of a mentorship. There could be a kind of a buddy attached to that. So this is how something is a continuous evolving in terms of the knowledge upgradation and the matching with the competency requirement for that specific function. So this is how we work on upgrading the skill.
Thanks a lot, Harish. The other question, I think a very critical question. Setu, I'll put a part of it to you and then part of it, Surya, to you, because that does mention about Bennett also. So how do you really identify an unknown risk and make a comprehensive risk framework to say that I'm identifying all the risk which can probably hit me tomorrow? Setu, you're on mute. Setu, you're on mute.
Yeah.
Yeah.
Very, very good question. One, my advice to whoever asked the question is definitely focus your efforts on the known risks, because I told you, I spoke about gray lines. 99% of the time, risk faced by organizations are very well known. It is just that you need to see to your left and right, and you will be able to spot whether it is a strategic risk or a compliance risk or whatever it is. But just to answer your question, you have to see this, that always ERM should use the strategic lens. Keep the business objective or your strategic objectives or business goals as your lens. If you keep that and view through all the developments, you will clearly know and ask whether this development is going to impact my achievement of business goals in an adverse manner. No, then it is not adverse. Or is it an opportunity that I will miss out, or my company will miss out if they don't encash on it? Because that is how we did our AI. We stumbled upon it, we made it as the same. And just to share this, we have a framework called within ERM, we have a framework called strategic risk and opportunity management framework. And that is how we have designed it, because many a times it need not be only an adverse risk, but it may end up that we may fail to spot a very fantastic opportunity, and that can be an existential risk for the company. But if you keep the strategic piece in in view, and that lens is used to apply across macro or internal developments to see whether it is going to help me or whether it is going to adversely impact, you will find unknown risk coming there very clear.
Thanks, Setu. Thanks a lot. I think Surat, you probably answered part of it. The specific question was that how did Bennett see the risk of coming from InShots, which is basically a digital news platform, and you spoke about that how frequently you change the risk identification approach to really see, and you still called it out as a risk from a digitization point of view, from a content quality point of view. So I guess that part of the question did get answered. We still have few questions left, but we are up on the time. So we will probably revert back. The questions we have not been able to answer, we will try to probably share some of these insights. And if you still want to have some clarifications, please do write us, and we will try to answer those questions separately. But thanks a lot. Thanks a lot for all the people who joined in. Hope you have a lot to ponder on and you have great takeaways from the session. Thank you for all the panelists, all the panel members for taking out time, sharing your views openly, and helping a larger audience to really take away some great learnings and implement in their day-to-day working. So
Thank
thanks
you
a
so
lot,
much,
everyone.
Nitin.
Thank you.
Thank you, everyone.
Thank you.
Thank you.
Thank you, Raja.
Thank you.
Thank you,
everyone.
Setu. Thank you, Chetan. And thank
Yeah.
you, Harish.
Thank you. Thanks, everyone. Thank you. Bye-bye.
Thank you.